which is organized by the Energy and Power Committee of the Institute of Directors, Nigeria. The Energy and Power Committee is a very important policy committee of the Institute. Important because it deals with a sector that is of great importance to the Nigerian economy. So, distinguished ladies and gentlemen, I welcome you all. My name is Dele Alimi. I'm the Director General CEO of the Institute of Directors Nigeria, and my role is quite simple to introduce to us our the eminent personalities who have agreed to share their thoughts with us here this afternoon. And I'll start by introducing our chief host, the President and Chairman, Governing Council of the Institute of Directors Nigeria, Dr. Mrs. Ije Jidema, FIOD. Madam President, you are welcome. I will also introduce the host, who is wearing, in fact, he's not wearing double cap, he's wearing many caps here today. An expert in the energy, oil, and gas industry in Nigeria, and someone who has lent his very good support to the Institute by sharing the Power and Energy Committee of the Institute, Mr. Victor Eromosele, Fellow of the Institute. Mr. Chairman, you're welcome. Today is not just our host, he's also the moderator of this program. So that's why I said he's wearing many caps. You're welcome, Mr. Eromosele, and thank you for being here. Also, I want to introduce someone who is also wearing quite more than one cap here today. And that is the Vice Chairman of our Energy and Power Committee, who is also here today as a panelist, Mrs. Audrey, member of the Institute. Madam, you're welcome. So I also like to move to the other panelists, and I'll start by introducing to you Mr. Austin Olorunshola. I hope I got that right. Mr. Austin Olorunshola is the Chairman of Energy Institute Nigeria. Mr. Olorunshola, you're welcome. And thank you very much for heeding our call.
Thank you for inviting me. Thank you very much. I appreciate it.
You're welcome, sir. It's also my pleasure to introduce another very important panelist, Mr. Theophilus Emua. Mr. Emua is the managing partner of LX Legal. Thank you very much, Mr. Emua, for joining us today. You're welcome, sir.
Thank you.
Yes. And of course, it's my pleasure to introduce Mr. Bite Adeniji. Mr. Adeniji is the managing partner of ENR Advisory and someone who is quite experienced in the oil and gas industry and who will be sharing his wealth of knowledge with us today. Mr. Bite Adeniji, you are welcome, sir.
Thank you very much.
Thank you. Distinguished ladies and gentlemen, it's my pleasure to get us started and start well. And I would like to invite the President and Chairman of Governing Council, Dr. Mrs. Ije Jidema, to welcome everybody. Madam President.
Thank you very much, DG. Thank you very much, audience, members of the audience. Members of the Governing Council of Institute of Directors Nigeria, as presidents and distinguished elders of the Institute, members of the Executive Committee of IOD Nigeria here present, our distinguished panelists and moderators, fellows and members of IOD Nigeria, distinguished audience, gentlemen of the press, distinguished ladies and gentlemen, it is a great pleasure to welcome you all on behalf of the Governing Council of the Institute of Nigeria, Institute of Directors Nigeria. So this National Stakeholders Forum on the Petroleum Industry Act 2022-21 with the theme Petroleum Industry Act, Governance and the Investor. This forum is another intervention by IOD Nigeria aimed at fulfilling its mandate to its members in particular and to Nigeria in general. As an institute that advances good governance, it behoves on us to create a forum like this where stakeholders can review the act, ruminate on the opportunities it portends, the structures it creates, the governance implications, and address the concerns that some of us have. This will help to engender better understanding and help the business community to take full advantage of the act. We are excited that the Petroleum Industry Bill has been signed to a law. Even though the nation waited for almost 2 decades to achieve this, while it may not be perfect, a perfect piece of legislation at the moment, all hands must be on deck to clean the rough edges. We must ensure that through this act, we will create a most conducive business environment for investors, both local and foreign, in the petroleum industry. The Petroleum Industry Act is expected to be a roadmap for potential and existing investors, and also provide clarity and guidance in this very, very, very important area. It introduces revolutionary and pertinent changes to the governance, administrative, regulatory, policy formation, and fiscal framework of the Nigerian petroleum industry. Expectations are very high that adherence to the extant provisions of the Act will bring about and ensure transparency in the industry, strengthen the governing institutions, and attract investments, amongst other laudable objectives. However, a number of stakeholders have expressed concerns over certain provisions of the PIA. Those concerns represent varying degrees of varying interests of stakeholders, which they claim may actually inhibit the successful implementation of the Act. It is therefore pertinent to address these concerns, and in a timely manner too, in order to ensure that the lofty objectives of the PIA are achieved for Nigeria's economic growth and development. The IOD Nigeria is therefore providing this forum for meaningful discourse by various stakeholders and interest groups, with the aim of appreciating various perspectives and working together to see how the public and private sectors can optimize the gains from the Act for the benefits of the economy as a whole. Distinguished ladies and gentlemen, today we are privileged to have in our midst distinguished moderators and panelists. These are notable people in the energy and power sector and also in the advisory arena. As Didi had introduced them earlier on, we have Mr. Victor Eromosele, FIOD, who is the chairman, Energy and Power Committee of our institute. We also have Mr. Wite Adeniji, managing partner, ENR Advisory, and also Mr. Theophilus Emowa, managing partner, LX Legal, and Mrs. Audrey Jo Ezigbo, MIOD, Deputy Managing Director, Falcon Corporation, and Vice Chairman, Energy and Power Committee of the Institute of Directors. And of course, the last but not the least, Mr. Austin Olorunshola, Chairman, Energy Institute of Nigeria. These are people that we would like to listen to and see what they have to say from their various perspectives. This carefully selected team of experts brings to the table decades of experience in the oil and gas and power and allied industry. They are highly skilled corporate executives, versatile business leaders with several years of experience working in various sectors of the economy. I am confident that they would bring these experiences to bear at this forum to provide us the needed information to the theme of the discourse that we have today. Ladies and gentlemen, crude oil means a lot to Nigeria. The export and import of the various byproducts of crude oil have great impact on Nigeria in terms of its social, political, and economic well-being. Petroleum products contributed about 9.3% to gross domestic product and amounted to $2.1 trillion in government total revenue last year, 2021. Despite the global pandemic, ignorance this is to do so at our own peril. We must therefore, as representatives of the private sector, support government efforts at sanitizing the industry and making it attractive to the right investors. The Institute of Directors, Nigeria, as the apex professional body in Nigeria, will be at the forefront of efforts to make the best of this natural resource. Despite the move, of course, we all know the move to renewable energy and decarbonization. But despite that, there is a resurgence in investment in fossil fuel. There is no doubt that full transition will take some time. We know there's a transition, but of course, it will take some time to achieve full transition. And oil is projected to remain relevant for at least the next 30 years. We would collaborate with stakeholders, all stakeholders, through our Energy and Power Committee to ensure that Nigeria gets what it really deserves from this God-given resource. I wish to encourage you to be open-minded and participate actively in this forum so as to maximize the benefits from fora like this and also generate ideas that will benefit the economy. I thank the chairman, Mr. Victor Eremosele, FIOD, and members of the Energy and Power Committee. I also thank the chairman of Research and Advocacy Committee, Mr. Professor Nat Ofo, and the members of the Research and Advocacy Committee of the Institute. Let me also thank the Secretariat, the management and staff of IOD for their efforts in putting this together. Thank you for participating. Thank you for listening. Thank you.
Thank you very much, President. Thank you very much. It's now my pleasure to hand over to the chairman of the Energy and Power Committee of the Institute, who incidentally is also the moderator of this event, Mr. Victor Eremosele.
Thank you very much, Dele. Thank you very much, Dele. And first of all, I have to observe the protocols. I don't believe in standing on protocols. Most people say, oh, let's stand on existing protocols. I think I would rather go through it. President of the Institute of Directors, Nigeria, Dr. Ije Jedema, past presidents, members of the Council of the Institute, members of the Energy and Power Committee of the Institute, speakers, panelists, and distinguished colleagues, ladies and gentlemen. In my capacity as chairman of this webinar and of the Energy and Power Committee, EPC, it is my pleasure to present my brief opening remarks. This happens to be EPC's maiden event since its inauguration last November, and therefore is of special significance. How relieved Nigeria and its most strategic industry were when 5 months ago, on 16th of August 2021 to be precise, President Muhammadu Buhari signed into law the much-awaited Petroleum Industry Act, PIA 2021. Implementation headwinds aside, a semblance of fiscal certainty is beginning to emerge. Crucially, industry players, directors, and investors, and stakeholders generally now need to understand how the new provisions will impact strategy going forward within the ambits of emerging governance structures. We've heard the names of all those who, these erudite speakers who will quickly bring us up to speed. The first speaker, Austin Olorunshola, not only is he chairman of the Energy Institute Nigeria, for those who do not know, he was a former director of the Department of Petroleum Resources. And equally, as you will hear later, an advisor to the House of Assembly at different times on this very important piece of legislation. Then, of course, we have one of the leading experts who will lead us through fiscal. So when you're talking about fiscals in Nigeria, one of the first names that occurs to you is Theophilus Emuwa, as the managing director of Alex Legal. And of course, we have our very cerebral and articulate Bite Adeniji. He's equally been through the corridors of power in his previous life. And he's the managing partner of ENR. I think they've just renamed themselves ENR Advisory. They used to just be advisory, but now there's an ENR tag to it. It will be followed by a very lively but informative discussion panel session, which I will moderate. And joining the panel is the amiable Vice Chairperson EPC, Mrs. Audrey Joe Ezigbo, who is co-founder and deputy managing director of Falcon Corporation, a leading downstream player. Ultimately, the EPC hopes to generate position papers on behalf of the Institute as part of its advocacy role on this subject. So for members present in this forum, please have your pen and paper and jot down as much as you can, because much later in our own sessions, we will want to be able to take you to share your notes so we can review and collate all the views and then put them to use to achieve what we want. Without much further ado, let's get started. The first presentation designed to give us the backdrop of the PIA. Like I said, he was not only the former director of the Department of Petroleum Resources, DPR, he serves, or served, I know he served, probably served, as one of the advisors to the legislators in course of the development of what now has become known as the Petroleum Industry Act. Over to you, Mr. Austin Olorunshola. You have the next 15 minutes.
Thank you, Victor. Let me see if I can share my screen. Can you see my screen?
Yes, we can. But okay, you want to use the slideshow? Thanks.
Yeah, it's on slideshow right now.
Yes, it is. Now it is.
Okay, thank you. So again, let me say good afternoon, Madam President and Chairman of the Energy and Power Committee, my friends, Victor, members of the IOD, fellow panelists, and distinguished delegates. Many thanks for inviting me to speak. Well, they gave me this topic, so they said it's understanding the spirit behind the PIA legislative changes. So I'll quickly then take you down a bit of memory lane from the start point in April 2000, go through all the physical and spiritual battles all through the years, the very painful navigation, up to final destination in August last year, when President Muhammadu Buhari himself put pen to paper and assented to the bill. We're still trying to get the exact number of days, but I think as at that count, it was roughly 7,800 days for the totality of the reform itself, right from the beginning, looking at all the policy framework and all that, until the end point where the legislation actually was on the table. So to be on the same page, let me start by contextualizing the very unique importance of energy to mankind. Simply put, energy is life, and I always like to say that. And it is the consumption of it that drives livability, prosperity, and sustainability. And as the world's population or sophistication, and of course the quality of life grow, so also the trajectory for more and more demand. However, such suction definitely must take due consideration of health, safety, as well as environmental impact on livelihood, as we now hear generally these days around energy transition and all that stuff. Globally, and more so in Nigeria, oil and gas play very multiple roles. Specifically for Nigeria, it's for energy, but more importantly, of course, it's where we get all our revenues from. And that is why the reform of the petroleum industry itself has sapped so much energy and occupied much space since that April 2000 when it was flagged off, and subsequent initial delivery of some kind of policy blueprint in 2004. So in the next 14 minutes, I will use these 4 topics quickly to unpack the topic, which I have been given. Looking quickly at how far we've come, what's broken that needed fixing at that point in time, the bumpy as well as all the protraction in the journey itself, then the end game and the key deliverables that we're all expecting. So how far have we come? Since commercial discovery of oil and gas in 1956, if you all remember, and of course, first export 2 years after, Nigeria has had a relatively very active and I would say very successful oil and gas operations. Granted, it's been a lot more skewed to oil, but thank God also with the PIA, there's a lot more movement towards the midstream as well as the downstream. And in addition, doing a lot more things in country rather than just exporting raw materials. So there's quite a lot we have gained in this 60 plus years. But the question is, could we really have done more? If you look at in terms of production, this is just production from 1960 to around roughly 2010. Really, I mean, both for occasional truncations, like say the Nigerian Civil War in the late 60s, and a bit of some geopolitical issues around the 80s, OPEC and all that stuff, oil production had hovered, and really oil plus condensate, let me put it that way, had hovered more or less around a flat of say 2 million barrels per day, which is an aggregate of onshore, shallow water, as well as deep offshore production. But if you also look at this one, although we had the highest the real peak production in Nigeria was in 2005, mid-2005, when we made 2 million barrels, 2.5 million barrels per day. Incidentally, this same reform had just started about that time. It was like 5 years thereafter. But if you just eyeball this chart, you'll see that since that day, everything had been more or less nosediving. What kind of coincidence is this? It was at the same point in time, we're trying to reform the industry, but we're just going on a slippery slope since that particular point in time. But no doubt, I mean, all the successes recorded since 56, like I said, had been propelled by more or less formal, sometimes informal reforms, using various vehicles of policies, legislations, and regulations, sometimes singly or sometimes even jointly. And we've gone through all sorts of, like I said here, about 4 phases really of such reforms, if you like. Now, but by the year 2000, oil accounted for Nigeria's about 30% of GDP, 80% of government revenues, and 95% of foreign exchange earnings. Now, apart from the contribution to GDP, which we know had dropped today, other indices still record near similar high levels, frankly speaking. Now, if you then go back to 2000, so why did the government trigger such a comprehensive reform at that point in time? And what was really broken that needed to be fixed? So even though everything then at that point in time looked rosy, good GDP contribution and all that, it was already becoming clear that the party will probably not last much longer if we continue managing or mismanaging this God-given endowment. Laws were generally becoming outdated. There wasn't anything called good governance. The NNPC could no longer fund growth as it was required at that point in time. The downstream was grossly over-regulated, so nobody wanted to touch it, even with the longest spoon. So there were quite a lot of issues at that point in time. And simply put, it was really that we're not managing the industry as it's supposed to be. And so I think it was good also that government really then identified the need for, if you like, a comprehensive overhaul at that point in time. Let me just show you some of the examples of the things that were happening at that point in time. When you talk of governance, it was so seriously confused. You had operators who were regulating regulators. Sometimes you just hear somebody get up and talk policy directions, and they were not policy people, and it was just so difficult to understand. There were all sorts of overlaps, there were all sorts of confusion, and not just that the agencies were confusing themselves, they were actually confusing the industry, and it really then affected operations and deliverables. What the PIA has done is what you see basically on the right-hand side, cleaning all that up and purely just having clear, separated, transparent, and accountable buckets of policy and supervision, looking at regulations totally separately, and then, of course, looking at commercial operations separately. Another example, which we saw at that point in time, there was so much fiscal deficiencies and challenges, all sorts of issues, unclear terms for domestic refining, and at some point, a lot of people applied for license, yes, and they got the licenses, but they couldn't move beyond that because terms were not pretty clear. Our fiscal terms were becoming weak at that point in time. Then the competitiveness were not certainly there anymore. Taxation was multiple, all sorts of things were happening around the fiscal space at that point in time. Another example was that then we started to see a lot of onset of socio-economic and socio-environmental concerns. The battle we're fighting today around the Delta, Port Harcourt, Bayelsa axis around the it's not yesterday it started. It started very, very long time ago. And I wish we actually started that battle at that point in time. Another example, of course, was the fact that we were getting a lot of money at that point in time, but each time the oil price dipped, we went straight into having malaria at that point in time because we didn't have any credible stabilization mechanisms. You know, the closest attempt, earlier attempt was having the excess crude account, but of course there was no legislation behind it. In fact, there was no withdrawal protocol, frankly speaking. So everybody just goes in and even if you fall inside the well, that's also okay. But that was basically what was happening at that point in time. And so a lot of myriad of issues at that point in time, and government saw really that definitely that these headwinds, the challenges will live with us for a very long time if we don't begin to look at how to seriously overhaul the sector. So the bottom line was that, frankly speaking, that the industry dashboard was not looking good. Whether you look at production, whether you look at operations, whether you look at governance, revenues, everything was completely going certainly in the wrong direction. I must also add here that at this same point in time, the noise as well as the volume of the sound of mistrust between investors and government were getting higher and higher. Probably, maybe, again, maybe it was coincidental because we then began to have national assemblies and all that. And, you know, so there was a lot of noise at that point in time. But given all that, what was seen and what was really unseen, government then inaugurated this very, very high caliber team, the OGIC 2000, and gave them very clear terms of reference to carry out a very detailed review, make recommendations to government. By 2004, of course, the policy report was ready, but it wasn't necessarily approved until 2007. By 2008, we began to see some kind of skeletal or draft of the legislation or what it will look like. But between 2009 and 2021, when the bill was finally assented to by Mr. President, that was the continuous evolution of the PIB. We'd also use the opportunity to reconstruct, of course, the policy document, because you can't imagine policy documents of 2004. I mean, again, that too had already been overtaken by events. So again, all that was rehashed, but again, like I said, went through all sorts of intense physical, spiritual battles, start, stop, until finalization, which happened August last year. However, the link again with the spirit and let's then look at the intent and how it all then shaped up in terms of what became provisions in the law in itself. I'll basically say that at the end of it all, the bill or the law itself, the whole journey itself culminated in, if you like, say 10 core objectives, which is here. I don't want to read through all, But these 10 core objectives were purely underpinned by 3 or so-called strategic pillars, if you like. One was good governance, okay, and efficiency in administration. The second was the accelerated value growth, because there was the need to really unleash growth in this sector. And the third was inclusiveness and shared prosperity. And if you go through the bill in detail, you see how all these were actually put to form in the bill, establishing this, creating that, and all that, and all that. And really, it showed clearly there was kind of a balance between governance, fiscal competitiveness, growth, and benefit sharing all across in the bill itself. At the end of the day, for me, 3 key opportunities came up as soon as Mr. President signed. It certainly ushered in a lot of new life into the industry. The first thing was we had completed, at least for that point in time, we were able to extinguish all the legislative uncertainties in the industry. So that's nose-diving production you saw since 2005 was purely because of uncertainty in the industry. Nobody really wanted to invest big money anymore. But as soon as this happened, at least it signaled, so not that the money has started coming yet, but at least it signaled, okay, no more uncertainty. I hope they don't touch the bill again and say they want to tinkle around with it. The second thing that really then happened was that we took an opportunity to establish modern laws, okay, and assured competitiveness, good fiscals in the bill. And then, of course, the third thing was enshrining good governance, finally, which had eluded us for so many years. I think I'll just end up with this. These are the kind of key deliverables we're looking towards if everything goes well, and everything means really the implementation of the Act itself. It's very good to have a very big book, good book on the table, but at the end of the day, it's human beings again that were wrong with it. But 5 key things which we must certainly be looking for, hopefully in another 2 or 3 or 4 years, when we're doing what I can call a look back, whether this act has really delivered. I'll be looking at, first is good governance, how much of it, how much of petroleum stewardship have this bill really delivered, okay? Secondly, what kind of level of investment are we getting, and is it going to be sustainable going forward? Because these are all really the key things why we started all this. Thirdly, of course, is growth. We can't stay as we are. If you continue this level of production you have today, even with the reserves you have, it will take you almost 100 years to finish. We don't have 100 years to market oil and gas anymore. So we don't have that. So growth, and then of course that then links me to speed. Okay, that then links to speed. We must see speed. Otherwise, the whole of energy transition matters. We will even overtake you at the end of the day. And of course, the last and not the least, frankly, the most important is harmony and inclusiveness. Let's make sure that we have a shared prosperity. Well, let's make sure that the host communities are seriously carried along. At the end of the day, all this is not necessarily for the oil and gas industry. It's really to rapidly generate revenues to catalyze industrialization of other sectors of the economy. I'd like to leave it there. Thank you very much.
Yeah. Thank you very much, Austin Olorunshola. In the time allowed, you did the most you can do. When you put very detailed slides, you know, I knew that talking to it would be quite tough, but you did a great job for it. I wish you could see us physically clap for you. I think it was a very well done job. I think we're all better informed. We now know the spirit behind the PIA. You talked about fixing the broken glass. I hope the broken glass is beginning to be fixed. The 10 objectives, the 10 objectives of PIA and the 3 pillars: good governance, value growth acceleration, and shared prosperity. They're all very nice, great spirits. Now, everyone wants to invest in the industry. Is the next question. Are the legislative changes good enough? And that's why we'll be taking the next paper. But before we take that, I know most of you will have questions as you listen to it. There's a Q&A facility here. I don't guarantee we will answer all questions, okay? But you just put your questions, and I'm sure the best questions asked will be answered. That I can guarantee you. But we cannot, in the time allowed, answer all questions. But they are important enough. We will take them on board, and even comments too, feel free. But I can give you the secret. Keep your comments or questions to not more than 2 sentences. Because if you write the usual long one, I'm sure it will not be asked. So if you keep it short, you stand a chance of winning the lottery in the Q&A. So the Q&A in this section will be a little bit of a lottery if you don't mind. Now, with that, let's move on. And the next subject is of great interest is PIA fiscal changes investors must know. As directors in various companies, we're all very interested. What is it in that PIA that we need to know that will actually boost us, give us that shared prosperity? To handle that is no other than an expert in fiscals, Mr. Theophilus Emoa, Managing Director, Elex Legal. Theophilus, over to you. You have 15 minutes. We're getting a bit into time, so if we can even keep it shorter, that would be great.
Thank you. I'll just share my slide.
Slideshow.
Can you all see it?
Yeah, we can see it. Go to the slideshow, please.
Yes.
Very clear.
Slideshow. The 7th item on top. 7th item on top.
Your heading is blocking it, so I have to move your. Find a way to move your. Yeah.
Yeah.
There we are. Good afternoon, all. I'll try in my short 15 minutes to quickly take you through some of the fiscal changes which this legislation has introduced. We'll start with what I would call the big picture. So basically, headline tax rates have come down. So what used to be 85% has come down to 60. What used to be 50 for the deep offshore has come down to 30. So that gives you an idea of the direction in which they're moving, and probably explains, as Mr. Olorushola said, why investors are now feeling a bit more comfortable, and they begin to consider putting their money into the industry. On the other hand, some incentives have been removed, and some opportunities for double dipping have been removed. So, what you win on one side, you lose on the other. Swings and roundabouts. Royalty, new model has been introduced. Previously, it was tied to production volumes only. Now it is also tied to price. So the government feels it should gain some of the upside when the oil price goes up. So there's a $50 price point, there's a $100 price point, and then there's a $150 price point. So at each of these price points, there's an additional royalty kicks in. Right now we are at $80 or so, so that means that the lowest rate is applying right now. But once it hits 100, additional rates would kick in. Then there's something else. The acreage sizes on conversion, or at the end of February 2023, when everybody must transition, would be going to be much smaller than today. That comes with its own consequences. Mr. Lawrence mentioned the objectives of the Act. I will just quickly mention the objectives of the fiscal chapter of the Act. According to that chapter, it is meant to establish a progressive fiscal framework that encourages investment in the petroleum industry, balancing rewards with risk and enhancing revenues to the federal government. When you look at that, you can see that they're talking about two opposite things. So they want the investor to be happy, but they also want the government to be happy. That's always going to be a challenge, but this it gives an idea of what they had in mind. Whether they achieved it, I think only time will tell. Another objective is to provide a forward-looking fiscal framework that is based on core principles of clarity, dynamism, and fiscal rules of general application. Again, they may be taking lessons from what has happened with the current act, which is the Petroleum Profits Tax Act. It was enacted in 1959, so that's over 60 years ago. And up until now, there are still provisions there which are controversial. So as between the taxpayer and the tax authority, there are disputes as to the meaning of certain provisions in the Act. So hopefully, again, they've succeeded in removing ambiguity. Another one is to establish a fiscal framework that expands the revenue base of the federal government while ensuring a fair return for investors. Again, this looks like two opposite things. So you want more money, but you want investors to be happy. I wonder how investors can be happy giving away more money than they would otherwise want to. But that's what this objective is suggesting. Then simplifying administration of the tax, promote equity and transparency. So these are the objectives of the chapter dealing with fiscal. Now let's go down to the details. What has been done now is previously all companies were only subject to the Petroleum Profits Tax Act. They were excluded explicitly from the Companies Income Tax Act. Under this new legislation, there's a duality. So upstream petroleum companies will be subject to both the Petroleum Industry Act and the Company Income Tax Act. On the face of this looks like, okay, fine, you pay the rate in here and you pay the rate in there. But there are some differences in the way the calculations are done. And this may have, or is likely to have, implications down the road. How this will be resolved, only time will tell. But hopefully the parties involved, especially the tax authorities and the government, will recognize this and come out with clearer rules that will guide everyone. Really, I mean, companies are not looking to avoid paying tax, but they just want to be clear that they're paying the correct thing. The way it's calculated will be done in the same way as it's currently done under the Petroleum Profits Tax Act. So you will calculate or estimate in advance and you pay monthly in installments. So that's not changing. The rates, as I mentioned, have come down. The most significant thing is that for deep offshore acreages, the hydrocarbon tax will not apply to them. So it is 0% for them, but they will still be subject to 30% company income tax. Then there are provisions that deal with terrain. Because the rates are not the same across board, you have to ring fence your operations in different terrain. So if you're in shallow water, you can't use the same company to do onshore because the rates are different. So this may present a bit of complication, and we'll see how that plays out. On the other hand, with the CITA, you can use, because the rates are the same, where everywhere, you can do it in one, account. But of course, once you've broken it up under PIA, you simply use the same broken up accounts to pay your CITA. The hydrocarbon tax specifically applies to crude oil production and to condensates and natural gas liquids from associated gas, not natural gas liquids from non-associated gas. So you've got these differences, which, I don't know how, easy it is in operations to separate one from the other, but this is the idea. It will only apply to crude oil and to things that come with associated gas. On the other hand, hydrocarbon tax does not apply to associated gas and does not apply to non-associated gas. It does not apply to condensates. It does not apply to natural gas liquids from non-associated gas. And then deep offshore acreages and frontier acreages. The incentives which used to be in section 11 and 12 of the PPTA, which allowed you to take capex incurred downstream and some, set it off against crude oil profits. That incentive has been taken away. Now, in fact, the act requires you to have a different company to do your downstream business. So, this is one of the things that I say has been taken away. The tax base with production sharing contracts, the tax base was the contract area, because you'd have 4 or 5 companies in one contract area, whereas outside of that you had one company. Now everything is going to transition, and it'll be done on a company basis. Again, this will have implications, and it's not so clear how it will be, how it will play out, but it's something else to think about. Operating expenses that are deductible under the PPTA only had to be wholly, exclusively, and necessarily. It did not have to be reasonable. So if you spent twice or thrice the usual rate for purchasing a piece of equipment, so long as it was wholly and exclusively unnecessary for the operations, it was deductible. Now, a reasonableness test has been introduced. So if the taxman feels, well, you paid twice the normal price, that's not reasonable. I'll only allow you to deduct the market price because for whatever reason you paid more than you should have paid. That's going to create a few interesting challenges. We're all aware of what the CBN said recently about importation, that is going to index imports. And if your importation price is more than, say, I think it's 2.5% above a certain benchmark, it will not approve your application for remittance of foreign currency. So I think, this is might be that sort of thing. Only time will tell how the tax authorities apply it, but it's certainly a move to reduce the room for maneuver that oil companies used to have. So gold plating will now be watched more closely. On the other hand, they've made it clear that certain things which were not deductible in the past will now be deductible. So decommissioning and abandonment funds were previously not explicitly dealt with, and it wasn't clear whether if you set money aside for that, because decommissioning might not happen for another 20 years. The question is, if you put the money aside, was that a deductible expense? Now this has been made clear, and it will be. Of course, you must, manage the money in a certain way to qualify. You can't just keep it in your books and spend it. And then host community funds are also deductible expenses. On the other hand, a number of things are no longer deductible. For a number of years, there have been disputes as to whether gas flaring fees and penalties were deductible. We've been involved in some of those disputes, and the view seems to be that they're not deductible because it's a penalty and not, a fee. In fact, for many years, the DPR stopped issuing receipts called, described as fees, and it was only issuing receipts described as penalties. And so it became more difficult for the oil companies to claim the deduction. But a big one is bank charges. So interest on bank facilities will no longer be deductible, whether it's at LIBOR or not. So this means that whether it is intercompany lending or open market, non-related bank lending, it's not deductible. We might question the logic behind this, but that's what the provision, the legislation says. Bad debt litigation costs, again, these are things that it's not so clear why they're disallowed, but that's what the current provision text seems to say. Of course, production and signature bonuses were never really deductible. Education tax used to be deductible. That's been taken away now. On the other hand, under the Companies Income Tax Act, bank charges are still deductible. So the question is, if you do your accounts, under PIA, you will not be able to deduct them, but under the CIT, you will be. So that's going to create some interesting dichotomy. How that will be resolved, again, is something that bears thinking about. Another thing that's been taken away, we used to have investment tax allowance, investment tax credit, and petroleum investment allowance. In fact, investment tax allowance used to be deductible from the tax liability, which was probably the sweetest allowance, in the industry. But that's been taken away. Now you have production allowances, which are tied to production, and they're deductible from your profits, not from your tax. And what this means, one of the implications of this is that if you don't produce, you don't get the allowance, regardless of your capex. So it might discourage people investing in expensive terrain. That's what I'm wondering. The experts in the industry might, want to comment on this, but I'm wondering whether this will not discourage, investment in areas where, the capex is high. Acquisition of petroleum rights used to be an item for which there was capital allowance, but recently there were a few disputes in the last few years arising from the sale by IOCs of their interest in some fields, and the value of petroleum rights was considered the majority of the sale price. And there was some debate as to how that was to be treated. The taxman was treating it in one way. Oil companies were saying it should be treated in another way. Now, because the companies hadn't been reflecting that item separately in their books, it was difficult for them to easily explain why that price is that much higher. So this is saying that you should set it out clearly, and then we can tell which is which. So we don't mix up acquisition rights from, with the port is being paid for the pipelines and things like that, which is usually a small fraction of the total price. Then there is some restriction on what you can deduct from your, revenues in arriving at your profits. Previously, you could deduct all your OPEX, and then there was a restriction on how much CAPEX you could deduct. It was a function of your profits, 85% of your profits. Now, the restriction applies to both OPEX and CAPEX. So 65% of your gross revenue is the limit for both OPEX and CAPEX. You can't deduct beyond that. Of course, you can carry forward what you have not claimed in any particular year. But it means that cash flow is slowed down, somewhat. The taxman gets more money earlier. There are other taxes, most of which you're familiar with: host community, NDDC. Education tax was recently increased from 2% to 2.5% in the Finance Act that was signed at the end of December last year. So that, and it's now no longer deductible. So it looks like you're adding 2.5% to the 30 or 60% or 45%, which the PIA is talking about. So that's something, of interest. Royalty rates, I had mentioned this. There are rates based on production, then there are also rates based on price thresholds. Yes, almost done. My takeaways, the Act provides for model contracts. Now, there's some suggestion that there'll be 6% carry on behalf of government. It's not clear how that will work. Conversion, companies need to decide whether they want to convert before February 23 or not. The transition for PSCs is unclear. How do you, what company do you transition into? Things like that. So these are some of the things that, we need to think about, which are not so clearly dealt with in the Act. But hopefully that they will get dealt with, especially with the government now using a Finance Act each year to make amendments to legislation. Thank you.
Thank you very much, Emua. The thing about tax is that it's not everything that you can logically explain. I still remember studying taxation. That's one thing I never liked about tax. It's not all about logic. So sometimes the rule is the rule. And now they put a new reasonableness rule. So that is difficult. And I'm sure for many directors, the one they cannot really bite is the fact that you go and take one hefty multi-million loan from somewhere, you're paying interest. Your interest is not allowable anymore. That is tough. That's tall order. Emoa, you have a lineup of questions for you, but I don't know how many of them you'll be able to take. But if you check your Q&A, you can answer. You can directly answer those ones you want to answer, so you can save our time during the Q&A session. I think that's one good way to go about it.
Sure.
So without much ado, we move on next. They've eaten into your time, so I don't know how you will do it. 10 minutes instead of 15, if you don't
mind. Apologies.
I know you are very good in being concise. So, and you'll be talking about. Well, listen to Bita Adeneji talking about the place of PIA in improving industry governance. That comes to the heart of what the Institute of Directors stands for, governance. Please, over to you, sir.
Thank you very much, Victor, and thanks to the chairman and the entire committee of the IOD Energy and Power for inviting me here. To be honest, Victor, I didn't come here for a 10-minute discussion, so you have to allow me to be able to do justice to the topic you assigned to me. I'll be speaking today on the issue of governance. The question of how the PIA addresses governance and how it pitches to investment. Let me start by saying I'm very indebted to Mr. Olorishola for teeing up the subject admirably in his presentation, because a number of things that I was going to discuss that he's admirably raised in his presentation. So in effect, this is what I'm going to talk about. The reform. Some background issues, then the mischiefs that the reform was directed to address, and then let's see how the PIA, responds to some of these mischiefs, and then we can then see make an assessment as to how the PIA might or might not be able to address governance issues. So this is. Essentially the journey that we walked from 2000 to 2021 when the legislation was enacted. And my position is basically is that all we were doing in this generation, this 20 years, the generation, was basically prepare for reform. We were just talking about reform. We were jousting about reform. The potentates and the spiritualists that Mr. Olorishola mentioned were all at work during this whole period. Some were hemming, blocking, and tackling the movement. But we eventually got there in 2021. legislation. But in that period, many things happened. Oil was discovered in many African countries, and the global energy order changed. So this is basically the implication of this 20-year journey to Nigeria, with the not move fast enough to basically put in a reformed legislation, which is what the PIA is all about. So as far as I'm concerned, the reform is just about starting. And let us see where we are with what we're trying to do. We could see that the role of government was opaque. You saw the slide Mr. Lawrence showed, how the different agencies of government were all basically just stepping each other, running into each other's lanes and sending wrong signals to investors. In consequence, the investment climate was affected because the question was basically who really is in charge of what. And then, of course, you have a legislation dating back originally 1959, amended in 1969, and by 2000 was hopelessly out of date. And the whole journey, 20-year journey, was designed to basically just improve the legislative framework. So it was not fit for purpose. You had some state-owned agencies, entities that were playing regulatory roles. Some of the entities are too much at the expense of other entities who were willing to actually do business in the sector. Then a very important issue was also missing. The issue of commercial regulation. Let me just quickly address problem in Nigeria, price of commodities, and then also the cost of the use of infrastructure. It's a thoroughly unregulated space, and so much mischief was done in that space. Also, the issue of access. If I own an asset and I really shouldn't be building new infrastructure, and I want to use yours, how do I access your facility if you have capacity? That space was not governed well, and there was a lot of gouging of other people's economic wins, and there was thinking that needed to be addressed, amongst so many other things. And then what we call in industry high above ground costs. Those things that happen when you go to government offices and you're pulled aside for a conversation, or when you're on the road and someone basically delays you and your vehicles don't move or your files don't move, and your cost of operations become unnecessarily high because of just poor governance, basically. And then issues around unrest in the Niger Delta, which when you really think about it, derives from, again, poor regulation. HSE issues leading to environmental incidents or long-term environmental impacts on people. You now have angst amongst the people in the host communities from these environmental impacts. Further angst to see so much value being taken from those communities and not much being shared. And that's the point that Mr. Lonshala was mentioning about value sharing, value benefits. Ultimately, what that does, this angst basically affects the social license. I cast my mind back to 2015, 2016, when the communities in Niger Delta were just so much literally up in arms, and petroleum production was so affected that the overall economy was so impacted. The government had to basically go in and engage in a very respectful manner, and everything had calmed down. These are the things that happen when an industry is not being governed properly. So these are the things that needed to be done with respect to investment climate, because it does affect the perception from those who might be willing to come in when they see that there's just too many problems. And they just say, okay, we'd rather just go to Ghana, we'll go to Angola, we'll go to Namibia. We might just want to Mauritania, which might have no prior history for production. We think would be treated better than we have been treated in Nigeria. These are the issues. When you look at the issues around facilities, Mr. showed us a slide where Nigeria was producing 2.5 billion barrels of oil per day, but then today that's 1.6. So there's headroom. There's capacity in our facilities to produce more oil. We could even produce about 3 million barrels, but without sufficient investment, then we have a loss at the end of the day. And these are things that needed to be, you just need to tweak them, use smart legislation to basically change the ballgame. The report card is that in the last 20 years, we've had very few new players come to Nigeria. Yes, it's good that we have become more indigenous, but this is a global industry. And at times you need big players to be able to channel in heavy investment into the sector. We've not had that. If anything, what we've had some high profile exits. ConocoPhillips left a few years ago, BG left, Shell, Chevron, ExxonMobil are threatening to leave. These are not very good signals for the country. So the issue is, what have we done? In this new legislation, we've basically enacted a new legal framework around hydrocarbon endowment. The framework provides a much clearer governance framework with an allocation of roles. So it's very clear today that only the Minister of Petroleum Resources can undertake policy making and supervise the sector, not an agency. And regulatory authorities given to two agencies, the Nigerian Upstream Regulatory Commission with respect to the upstream, and the Nigerian Midstream and Downstream Regulatory Authority with respect to midstream and downstream issues. And then NNPC and other players basically are the regulated entities who engage in commercial activities. So the lanes are much more clearer and the rules are very, very clear around what happens within these lanes. What's also interesting about this legislation is the introduction of some really exciting regulatory tools. For the first time, we have economic regulation brought in through rules around how you manage economic power or monopoly power in some cases. So that's competition regulation. That's very important, particularly if you see how in the Act, you see how there's a separation of upstream from midstream. There's a distinct midstream now. The midstream is the infrastructure segment. I need a lot of rules around how owners of infrastructure can manage the infrastructure in a manner that just doesn't kill the competitive process. So that's very important. Now, when you look through all the licenses, you see how the rules basically are set to basically just send a signal that everyone's got to contain their behavior, their economic behavior, in the interest of the market. Then a big development, which is something that has been a major issue for decades, is basically the rule that any new grants of upstream licenses must be done on a competitive basis, which means the power that a Minister of Petroleum Resources or the president used to have to grant upstream licenses on the discretion basis, power is gone. Then another rule is for time limits. I mentioned about how the regulatory process was becoming quite excruciating for investors. So with these time limits, in some cases, the time limits are 90 days, 60 days, 90 days, 120 days, within which certain decisions have to be taken, must be taken by the regulator, failing which, right, whatever the application is, right, will be deemed granted by law. And that's important because what it does is that it puts pressure on the regulatory system to be up and doing and to be responsive, right, to the regulated entities who need to move their business along. So days when a file will either go missing or not be treated for a year, 2 years, those days are gone according to this law. And that's a very, very important win under this new act. Then you also see throughout the legislation how respectively, the regulators and the regulated entities are meant to basically report either by publications or by making disclosures or by through the registers that are created, report their activities so that there's just more transparency around what goes on in the industry. And then that's really, really important for an industry that used to be seen as a very opaque industry. Then new innovations around the midstream. If we're to basically, if we're to seek a midstream license, you have to have an economic justification for that license. You've got to make a case. You've got to run a model. You've got to sit with the regulator and justify to the regulator why you must have the license. And demand, and then this from economic perspective. Now see how for the public. And I see in there is embedded very careful, which is basically that you cannot duplicate assets. So the regulator has a mandate to ensure that if there's capital in entity, there will be access to a third party willing to use the asset, rather than that third party building a similar facility next door. And so that's waste, and that doctrine is embedded in the law to avoid it. And then cost regulation. The gold plating that Theo mentioned earlier on is really embedded. That principle is there very clearly in the legislation. These are things that basically were being put in to basically address all the that really just didn't make sense, and the net loss was to the federation. There's a tariff regime for infrastructure. So basically, if you were to invest in infrastructure today, based on that tariff methodology, you will have a clear sense around how you're going to make money, how you're going to get your return. Of course, you make that case again to the regulator. Once it's agreed, and that'll be a tariff, and it's clear. Then the open access network code, which provides open access to facilities, as I mentioned earlier on, that's there. It's a regulatory instrument, very important for competition, and competition is key in the sector. Because what it does, on side, which is very important, given the legacy of the oil industry, operators of facilities are required to basically, as a condition for licenses, have an environment plan to basically on, to the issues, and then also to be able to decommission and have a plan and a fund for decommissioning. Well, this is basically render the regulatory structure. I'll move on from there. Yes, okay, so to the question as to how or if the PIA will improve governance, I say yes and no. Yes, to the extent that the rules are clear and the innovations I've mentioned are very good innovations, they're very modern, they're very best practice innovations, and the regulatory framework is substantially good. But the issue, the problem we like to face is that the agencies are not independent. It would have been best if the regulatory agencies were independent, but the government did not yield on this issue. Then also, we need to worry about whether future ministers will be able to effectively supervise this sector to the extent that the law missed an opportunity to create an engine room in the office of the minister to help him think out policy and supervise. So that's a problem. There was an opportunity missed. We should expect interagency conflicts on environmental regulation and on competition regulation, because there are two sets of agencies within the sector, and there are other sector-wide agencies that deal with environment and with competition regulation. So they're going to joust. that's to be expected, and time will sort that issue. I'm not a great fan of the bifurcated regulatory model, 2 agencies for a sector. I would have preferred one. I think there'll be high costs and time and efficiency issues for investors, and it will be an issue. I'm concluding this, my final slide, Mr. Romosele. The framework is new regulatory. You must necessarily expect risk. There'll be headwinds. It will take time for this framework to settle, and for a proper governance framework to emerge. It will take culture rather. It will take time. You merged about 4 or 5 different sector agencies, and you created 2 out of them. So people are basically now they have to basically clear their minds around how it's a new thinking, and they have to try and understand the laws they've invested with and take away their past culture. So that's an issue. Again, I go into the way we do things in Nigeria. NERC. The NERC was established way back in 2007 or so. NERC is still not settled as a power sector regulator. From time to time, the government of the day invades their work. I remember 2015 when President Jonathan stopped NERC from issuing new tariffs, even though the law required them to do so. The power sector till today never recovered from that. More recently, in spite of very clear petroleum policy and clarity in this PIA, this new PIA, with the ink of the president hardly dry on the document, this new PIA, the government of the day reversed, not just policy, reversed a statutory commitment in the PIA by not proceeding with the deregulation of the downstream sector. In fact, the government says, we're going to amend the law, and that's a new law. To the topic of this paper, governance and investor, that is a very, very bad signal for investments, because what it means to the investors is that a government that does not stick by its policy and statutory commitments will violate my investment. That is a very bad signal. It's a huge governance issue with legislation that's taken 20 years to make. The 20-year period was a period in which the entire system was basically trying to joust around the issues. And you would have thought that by enacting that legislation, basically the Nigerian political potentates, industry giants and players have all settled their issues. But clearly the issue is not settled, which means tomorrow, any new thing may happen. It's not good for investment. So basically what I'm saying is the political risk around the industry is very high. And the state is not settled on issues. And clearly our political system is not mature, right? So that's clear. Otherwise that wouldn't have happened. It was a very worst thing to have happened to the PA.
Okay.
So clear about that. It's basically about the culture of governance in Nigeria. The culture of governance basically is not respectful of law, unfortunately. So that'll be my contributions today. Thank you very much for inviting me to speak to you today.
Thank you very much. Peter, I know you're not a 15 minutes man normally. So you didn't surprise me at all. It's just that when we have a time to work with you, part of good governance is to keep people to their time frame. That's why you have a chairman. You know. Okay, it was a very nice talk. We now know a few things. We now know that the clear lanes competition regulation is good. You started with governance mischief. You seem to have ended to say governance mischief is not disappearing in a hurry. Interagency conflicts will arise, and it will take a few years for governance culture to emerge. And the issue of culture of governance in Nigeria, I'm sure we can spend a whole day. We can have a separate lecture for that. But unfortunately, today is not a day for that. We're just talking about Petroleum Industry Act governance and the investor. We want to keep to time in the process of doing that. There are lots of questions. We're going to take them after the panel session. So without much ado, I guess we're all set and ready for the panel session. And the panel session will be about arising opportunities and challenges in implementing the Petroleum Industry Act. So it's not just all about all we've had. And we have a number of questions to tease them out. We have a little rule within us. We're actually going to be more rigid because I will actually be moderating in direct way. So we may not have the liberty of speaking long. We expect answers to be brief, pointed, and interesting. We want to make this session interesting and lively and cover as many points as we can. And we have on the panel, as you can see, the 3 speakers, but in addition, we have Audrey Joe is a Igbo who happened to be the Vice Chairman of the Energy and Power Committee in addition. And we expect primary responses to be 2 minutes and follow-up 1 minute. But we're going to start by opening up with the first 1 minute only answer. And if you don't mind, I'm very polite usually, but if I'm impolite, you will understand why, because people don't want to stay long when we are doing online shows. So we are very sensitive to that. So we want to save as much time as possible. So the first one is, in 1 minute, what opportunities do you see PIA presenting to present and new investors? Let's start with Austin Olorunshola. 1 minute, please.
Oh, thanks. Can you hear me?
Yeah.
Okay, and I think I touched on a few of that. I think the biggest really opportunity that the PIA presented was this so-called removal of the uncertainties around the sector in the first instance, because nothing had happened in the last 15 to 20 years. Because, you know, the type of our business require very stable, certain, clear, long-sightedness, okay? If you don't have that, it's really difficult for anybody to go in that direction, because of the break even, not to even talk of real profit. So really, for me, that's one of the biggest opportunity provided. Extinguishing uncertainty.
Okay, let's leave it at that. Removal of uncertainty. Audrey, Joe, what will you say is your 1 or 2 opportunities you see the PIA presenting in your own sector, for example?
So, good afternoon, my co-panelists and ladies and gentlemen. My pleasure to be here. I think that the PIA is definitely a very strong signal in terms of optimization of the opportunities in the oil and gas sector. I want to anchor my comments, as you know, gas is my space, so I'm going to put it, just talk around that. And I think that what we've done really is to send a strong message around the buildup of the value chain, right from the exploration and production point up to that midstream critical infrastructure build-out that is required, and all the way into the downstream. So when we think about Nigeria from a gas perspective, Victor, obviously, I think it's very clear that we have a potential to have become a gas superpower, really, to be self-sustaining from an energy perspective, leveraging on gas. And the big challenges have been around production, have been around infrastructure, and then building a robust domestic consumption market. So I think that the PIA now provides that fiscal clarity and the frameworks around which investors can now have that much needed certainty to be able to progress investments in that space. And I think there will be a spill-out effect into other sectors of the economy. I'll anchor my comments there for now, Victor. Thank you.
Thank you very much. about the robust domestic markets. That's certainly something. What about Theophilus? What do you think?
I mean, I'm focusing on the fiscals. I think reducing the rates does make it more attractive, although we don't know what other countries have done. You see, when you move your rates down and they move theirs down as well, then that benefit disappears. And so the investors are then looking at other things like country risk and things like that, where we don't score very highly. As Guite has described, has said, we fail woefully in that area. So if all we're offering is nice rates, we can get easily beaten by the next country. So really, we need to work on that aspect of things. The policy uncertainty, consistency, that's where the work needs to be done. But otherwise, I mean, we have the product under the ground. You know, I mean, it should be a no-brainer, but we shoot ourselves in the foot.
Thank you very much. At least for now, it's attractive. What will it be attractive tomorrow is a big question. Guite, your one opportunity, please.
I'm sorry, I lost the connection, so you have to.
Okay, your one opportunity. The question is, in 1 minute, what opportunities do you see PIA presenting to present and new investors? Just 1 minute and one opportunity. I know you want to speak longer. You won't be allowed to dispute.
You don't know that. You don't know that actually. All I can tell you is this. To the extent that the PIA has come at a time when the energy transition is basically just in its onset, right? I think basically the big opportunity for Nigeria and the PIA and investors is gas. That is the fuel that has been adopted by the whole world. The entire global energy policy is basically circling around gas. The PIA speaks to gas. Nigeria has gas in abundance. So basically, let's make that dash for gas. That's the big opportunity.
Excellent. So PIA speaks to gas. Okay, let's leave it at that. Next, this is for Austin. And then the follow-up by Guite. The question here is, Section 53, subsection 7 anticipates good governance of the NNPC Limited as it mandates conduct of affairs on a commercial basis in a profitable and efficient manner without recourse to government funds. End of quote. This is a laudable standard and aspiration that eluded NNPC the corporation. Question, how feasible is it? You have 2 minutes to say that. Answer something on that.
Okay, I mean, I guess first and foremost, this was one of the very difficult provisions going through all the years of delay, actually getting it into the bill or into the law itself. But if you recollect, one of the major problems of one of the core reasons for even this reform, right from 2000, was how do we fund NNPC on a sustainable basis? And this speaks to that. And that was always what we carried as a flag. If you don't do this, that question will never, or will actually remain unanswered really forever. So indeed, I guess how feasible it is. The first thing is that at least the PIA has provided the platform for that, i.e. the structures are there, the provisions are there. And I will say, even the implementation has started. Granted, one would have expected a few real things to be done. Yeah, but I guess the train has left the station. It's a shame. It's a shame you have a big company like, or a corporation like NNPC sitting on this kind of huge assets, but they can't easily walk to any bank and take money, okay? Because governance is really not there, accountability is not anywhere. But I will say, like, really, the structures have been defined. The mandates are clear in the law. The law has really basically asked for some bit of accountability. The real issue now will then be the human beings to run it.
Okay.
And
okay. I have to cut in there. I know you will go longer. Okay. So there are difficult hurdles. Commercialization is obviously a difficult hurdle. Platform and provisions are there, and it could be better. Any addition in 1 minute, Peter?
It's feasible. It's feasible. Just that we are sitting on world-class assets, which gives you something to pivot on. But you've got to green the corporation as much as possible. You've got to green some of those assets as much as possible. If you try to green them, you will find money. Right. That's Excellent. Really where the smart money is these days. Yeah.
Excellent. I take the first part. It is feasible. Right. Next question is, going by sections 260 and 302, many upstream companies will be exposed to both hydrocarbon tax and companies' income tax. There's a duality here. How best can these companies manage this dual exposure? Of course, Theo, that's yours.
Thank you. When you say how best, that's a tough question. I mean, it is what it is. The lawmakers have made the law, and they have left it with contradictions. So the rules for deductibility under hydrocarbon tax are not quite the same as for deductibility under CIT. The way you can consolidate operations, in one are not the same as that in the other. So these are challenges which they will have to deal with. But I think that, with the right accountants and auditors, they can overcome this, because it is nothing new, to have a company or business that has different types of things under it, and they find a way to, manage each operation and see which one is profitable with in a group company. That's what they're doing in a group of companies. So it is looking difficult, but I think they can do it, ultimately.
Okay, fine, doable.
Yeah,
doable, but plenty of hurdles and challenges.
What can be done?
Better you agree, I guess.
I don't always have to agree.
Two lawyers never agree on anything.
All I can tell you, you've got to order your affairs, right, to stay either in the upstream, right, or the midstream, right, because the tax rules differ depending on where you are, right, in the chain, right. So, but wherever you are, you're going to be hit with carbon tax if you're upstream, CIT if you're midstream or downstream. Then after that, then as Theo said, you get your accountants to work and see how you can basically take the benefit of whatever incentives are available to you. But you're fundamentally going to be exposed to either, depending on where you are in the chain.
Okay, thank you very much. Now let's take the next one. In the spirit of, I quote, the decade of gas, that has been seen recent rapid growth in CNG, LPG, and domestic LNG. The PIA copiously has many provisions, for example, sections 125 to 173, covering midstream and downstream gas operations. As a key player, do you see these new PIA provisions boosting or promoting opportunities in the gas business? Audrey, of course, that's for you.
All right, thanks, Victor. Yes, absolutely, I would say that. Now, I think that is very instructive that as we're talking decade of gas, we also then enacted the PIA. That alignment was very much needed in the industry. Beyond the provisions specifically that you referred to, there's some things which I think are also interesting to note in terms of boosting gas investments. So if you think, for instance, about, I believe it's section 311, subsection 10, it talks of the savings under the savings provisions whereby the tenets of the existing gas sales agreements are preserved, even if there's some element of conflict within the PIA, at least for some time. And I think that kind of stability is important for existing commercial constructs and contracts that are running within the sector, and is a good signal also to potential investors. And of course, we've all talked extensively around the improvement in the tax regimes, the reduced royalties, and the rest. I think that when you look specifically around the provisions, the extra 5-year tax holiday for investors in gas pipelines, if you look at the alignment within the PIA of the provisions of the network code, the open access provisions, and the rest of that, it signals a more robust market. It signals more clarity from an investment point of view. And I think that one of the things that Nigeria needs at this point in time is to see a huge build out of infrastructure, as well as then leveraging on the virtual pipeline technology to make sure that we can get gas to the most remote parts of the country. And of course, you know that we're looking at different things. We're looking at rail, we're looking at marine transportation of gas. So yes, I think this is a good time, it's a good signaling. The things that could perhaps stand in the way, again, are going to come to how effectively we're implementing those provisions, right? And I know that between Wita and Mr. Lorishola, they've also spoken to, these early days, seeing one or two things that are not giving that kind of investor confidence. But other than that, if we can just do what it is we say we do what the law says, I think this is a great time for gas. The opportunities are there, and now we have the backing that can provide some level of certainty that's much required to make sure that we see these projects come to the fore within the sector. Victor.
Good. Austin, you support, do you?
I really wanted to support Audrey on that.
Austin?
And just probably just, yeah, can you hear me?
Yeah, go ahead.
Can you hear me?
Yes, we can.
Oh, okay, good.
Yes,
I said I was willing to actually support Audrey on that, really, because, I mean, if you just lift it up a little bit, 3 key things. The first is that the PIA itself is much more focused on the midstream and the downstream, so which is a very good thing in the first instance. The second thing is that we have seen a build-up of the policy, starting from the 2007 document, which Bite co-authored. Then that then evolved into the year of gas in 2020. And that then moved to become a decade of gas in 2021. These are all policy evolutions, okay, that are all really aligned. And then what better time than you then have a PIA that actually put legislation, really putting teeth into all that. I think we can't have it better than these in terms of having the fundamentals in place. Again, let's hope that we have people that will run it.
Okay, excellent. There are still more questions, but I'm looking at my watch, so I'm probably just going to take one more, take slightly more, which is, given the disparity in the size or in sizes between the OPL, and OPL basically is 2,950 square kilometers, and the new PPLs, depending on the terrain, 1,000 square kilometer. Question, do you see technical legal issues arising in conversion? Wita, you want to take that in 2 minutes?
I think the law is clear about this, and that it's appraisal. You do appraisal program. If you have a commercial discovery, you do it with the FDP and apply for a PPL. We have a significant gas discovery. So those are the 3 scenarios. So once that's clear, the next one that happens is we now hit the philosophy of the act, which is basically let us move away from this large acreages, right? That basically are underutilized. There's a loss of the state. So basically what everyone has to now understand is that you're going to literally be limited, right, to your area production. Yeah. With a decent perimeter, of course. Yeah, and if you don't use it, you lose it. You drill or drop. So those are some of the regulatory tools, right, that I was alluding to earlier on. Those are really innovations.
Yeah.
And that's a new way. And Nigeria doesn't have time anymore for people to sit on assets for the next 20 years. There's no such time. So everyone has to fit in with this new regulatory model.
Yeah.
Okay, thank you very much. So can we just give them a round of applause? Thank you very much, members of the panel, for teasing out those questions. I have some more, but time has timed us out, so we're not going to take them. But when we do see after COVID, we can always take these things. Now, Q&A. Let's try to take a couple of Q&A. One comes from this one is from Olalere, B. Olalere. The timing of investment after PIA. It's based on other climes. How quickly, Austin, and it was directed to Austin, how quickly do you see us starting to get investment? It's already 5 months. Are we going to start getting investment? When will this chicken be laid? Now that the PIA eggs have been laid. Any idea of the gestation period? Over to you, Austin, in one breath only, please.
I think it's a difficult period. I think it was, Bite even talked about investments are actually leaving the country right now. And we're talking of attracting it. The timing is really not a particularly auspicious one. We are also going into an election. Implementation is not going, of the PIA is not going the way the law itself really intended. And as we are talking right now, there are all sorts of unintended consequences of the way some of the legacy issues, court cases are still ongoing and all that. And then Bite talked about the fact that there are still attempts to even tinker with the act. You know, there are so many signals in the air that, frankly speaking, the earliest you will begin to see any major investment coming in this way, frankly speaking, maybe 2024.
Okay, after our famous 18 months, I'm sure you all know how we derived the 18 months, okay? Are there others who want to comment on that before I quickly run away from it? No, okay, I think it's better. Okay, the other one, somebody asked about marginal field fiscal regime. Is there any benefits coming to marginal field players, or has PIA ignored them? Anybody can take that.
Well, there are no marginal fields any longer in the PIA. I mean, to the best of my knowledge, the way the fiscals basically work on a sliding scale, right? I mean, on a progressive scale. If you are small, you pay small. If you are big, you pay big. It's just a straight line thing. So it's not really as we had before, where a group of people called marginal field players had to be kind of ring fenced or secluded, or carved out. It's no longer so. It's completely open from small field playing to large field playing.
Hugh, do you agree?
Yes, I agree completely. The idea is to, when they convert, they'll get their PML or PPL, whatever it is, and they'll pay the appropriate taxes depending on their terrain. You know, no special treatment anymore. In fact, one of the things they got in the past, which was very controversial, was pioneer status under Jonathan. And of course, when the next government came, the tax man went and said, no, that was wrong. Give me back my tax.
Excellent. We would have loved to take all the questions. but we've been timed out. But before I always take one question or comment from the president of the Institute of Directors, because I just want to hear her voice, nothing else. And I'm sure you all want to hear her voice speak on anything she feels like speaking about. You have your 2 minutes, madam.
Oh, thank you very much, Mr. Chair. Well, we have to be optimistic, even though, one of the discussants said,
yeah.
I think she's muted. I believe she's
muted. Kind of.
Kind
of, yeah.
It appears you are muted, madam.
Oh my God. Thank you very much, Mr. Chair. I was just saying, we must be optimistic. Sorry.
Yeah.
And my apologies once more. Mr. Chair, I'm just saying that we must remain optimistic despite the challenges. As one of the discussants said, this time is not quite auspicious. I mean, there are so many things to contend with. The challenges of transition, the elections coming up, and so many other things. But we must not be deterred. Even while the transition is going on to renewables, I know that such transitions, whether local or global, are not so, it's not as easy as they may seem. So we must optimize, we must make sure that we take advantage of this in doing whatever we can at this moment in utilizing our natural resources. Thank you very much.
Okay.
Yep, thank you very much, madam, for those fine words. We are beginning to round up. What's here is the closing remarks by chairman, after which we'll take the vote of thanks from Dele Alemi, who's the Director General of the Institute. By way of closing remarks, I think we've had a very lively session. We have learned quite an awful lot. The fact that we still have not of 210 out of the nearly 250 who started still online, so just that we've managed to keep them reasonably engaged. And the president was spot on when she said that do not expect a perfect piece of legislation. And I'm sure there's no piece of legislation anywhere in the world that is perfect. And I think I do share her. What the noise in the background will still be there. I mean, there were questions like, oh, to what extent will we be affected by this controversy surrounding the removal of subsidy and so on. I think those sort of noises will continue. There might be even louder noises going forward, but we would push on. We would at least our 7,700 days, if I quote him rightly, which Austin talked about, is over. The baby has been born, and the baby will crawl around, and we have to protect the baby from touching dangerous things, you know. But the baby has been born after 7,700 days. Congratulations. We're going to make the most of this baby. If we had no baby, now we have one. And so I think that is a very good thing. The broken glass will be mended in due course, taking the metaphor from Austin Olorunshola. We no longer need the spiritualists. The spiritual battle is over. You know, I hope, I do hope. And Emoa, I'm sure the double dipping opportunities have been removed. Those of you who have to borrow, you better think twice. You need to rerun your model because you're not going to get any tax cuts. So there's a slash in your tax rates, generally speaking, but There are other things you will not. And then the interpretation of what is reasonable, reasonableness rules have changed. You need all your consultants around you to be able to do it if you run any company. And of course, the governance mischief will not disappear because we remain Nigerian. But at the same time, we'll be governed by world-class standards, and the Institute of Directors stands for good governance going forward. And I'm sure we will do that. And hopefully, the Institute exists to promote this culture of good governance. So we've had very exciting times, and we equally had a very good panel session. So we know the opportunities, we know all the challenges. And so we all have to get back to our desk and make things happen. Make things happen, fix it, no excuses should actually be the refrain. So on that note, I give it to I hand over the button to Dele Alimi to give the vote of thanks.
Mm-hmm.
Chairman, I don't know if it's mine, but I can't seem to hear him again.
We can hear you.
Oh, okay. I think I can. I think we just want me to give the vote of thanks. And that is a great honor to do to this wonderful array of experts who have been able to retain over 200 people here listening ardently in the last 2 hours. I want to say a very big thank you to the panelists. Just like the chairman, I will just mention everyone and then say thank you. Mr. Austin Olorushola, I say a very, very big thank you. Your wealth of experience has given us quite a lot of information. And I think, like the chairman said, you have even given us some hope too in some of your intervention. I say very big thank you to you. It's to appreciate your coming. Thank you very much, sir. Mrs. Joe Ezigbo, I was, when I saw the question on gas, I knew it was good to come to you. And I was waiting, and I'm very happy that you, for some of us who may be considering investment in that sector, that subsector, you've given us hope. And I say a very big thank you to you, madam, for the intervention. Mr. Bite Adeniji, thank you very, very much, sir. We appreciate you coming. And from the comment I read from the participants, they really enjoyed the slides and your intervention. And of course, to Mr. Theophilus Emua, thank you very much, sir. It's been a wonderful about 2 hours now. And I want to say thank you on behalf of the Institute. And of course, to the President and Chairman of Council, I say very big thank you, madam. Throughout the period, I saw you were listening attentively with your video on. Thank you very much. That's part of the role of our Chairman of Council. Thank you very much, man. And of course, to the Chairman and members of both the Energy and Power Committee and the Research and Advocacy Committee, I say very big thank you. A lot had gone into this. We started planning this sometimes last year. A lot of things has happened since then, but like we've always said, this will always be a topical issue. I say very big thank you. And Mr. Eremosele, personally, I want to say thank you too for the way you have expertly moderated this event. Thank you very, very much. And to our over 250 participants, I say very big thank you for the Institute. We hope we've been able to give you the information you require. And I look forward to those of you who are not members of the Institute yet. Like I always say, this is what we do. It's all about putting information at the disposal of the people and ensuring that we preach the gospel of good governance in all sectors of the Nigerian economy. So I say very big thank you, and I wish you all a very wonderful evening. Thank you very much.
Thank you very much. Have a good day.
Thank you. Bye-bye.
Thank you very much, everyone.
Thanks so much indeed.
Thank you.
Nice evening.
Thank you.